In the dynamic world of finance, where numbers and regulations intertwine, one principle stands vital to financial clarity and success. Welcome to the realm of mastering the revenue recognition principle, where the key to unlocking sustainable revenue growth and regulatory compliance lies within your grasp. In the world of finance, revenue is the lifeblood of most companies. It is the single most important line item on their income statements. But what exactly is revenue recognition? It's the process companies use to determine whether a transaction qualifies as revenue. This process is governed by the new Global Revenue Recognition Standard effective from 2018, ASC 606 in US GAAP and IFRS 15 in IFRS, titled Revenue from Contracts with Customers. This standard lays out a 5-step approach that ensures consistency and transparency in recognizing revenue. Step 1 is to identify the customer contract. This contract outlines what products or services the company has agreed to provide to the customer. Imagine a software company entering into a contract with a client to develop custom software. The contract specifies the scope, requirements, and expected delivery date, making it a clear customer contract. In Step 2, the company determines performance obligations. These are the specific promises made within the customer contract. Consider an electronics company selling a smartphone bundled with a warranty and a service plan. In this case, the performance obligations include delivering the smartphone, providing warranty support, and offering service for over a specified period. Step 3 is all about establishing the transaction price. This involves determining the amount of consideration the company expects to receive in exchange for fulfilling its performance obligations. An automobile manufacturer sells a car with a list price of $30,000, but due to a promotional offer, the customer receives a $5,000 discount. In this scenario, the transaction price is set at $25,000. In the 4th step, the transaction price is allocated to various performance obligations. This ensures that revenue recognition aligns with the value delivered by each obligation. A telecommunications provider bundles a mobile phone with a data plan for $1,000. The standalone price of the phone is $500, and the data plan costs $600 separately. The allocation process might assign $400 to the phone and $600 to the data plan. The 5th and final step is to recognize revenue when or as a performance obligation is satisfied. This step ties revenue recognition to the actual delivery of goods or services. A software company promises continuous updates and support for its product for 2 years. Revenue recognition occurs ratably over those 2 years as the company continuously delivers updates and support. Now let's apply these concepts to real-world scenarios. We'll explore revenue recognition in the context of Microsoft, a tech giant offering a multitude of products and services. In 2019, Microsoft's revenue reached a staggering $126 billion, highlighting the magnitude of their financial operations. Microsoft's balance sheet shows $37 billion of unearned revenue, most of which will be recognized in the upcoming quarters of the next financial year. Microsoft's annual report provides insights into when and how much they recognize revenue. First, revenue is recognized upon the transfer of control of promised products or services to customers. Second, in an amount that reflects a consideration expected in exchange for those products or services. As we conclude this journey, we've uncovered the complexity of revenue recognition. Companies must follow a structured framework applying these 5 steps and real-world examples to ensure transparency and compliance with accounting standards. Keep this in mind and you will master the revenue recognition principle. So what are you waiting for? Subscribe now to our channel for more videos and insights like this. Until next time, keep counting those coins!